Hello and welcome to your Global Markets Technical Outlook for the end of Q1 2022. Normal disclaimers apply as we start this quarter off with a quote from Blaise Pascal, who says, "All of humanity's problems stem from man's inability to sit quietly in a room alone." Well, we're thinking about as we look around the world and see the many woes that's befalling us right at the moment. Turning to the US stock market, and on the monthly chart we can see the rise in volatility as the market pushed through that 4,000 level, made it to about 4,800 and is beginning to pull back. 4,000 would be a likely target, you would think, but definitely buyers in the area, as you can see from these long tails in the candles. On the weekly chart, you can see that it's just exhibiting more of a loss of momentum than the failure of the trend or the start of a bear market or anything like that. Just at the moment anyway, we can't really draw too many more conclusions than that. Again, you can see the buyers stepping up at these lows as the market pushes lower. But 4,000 would be the likely point of support. Interestingly, on the Ichimoku chart, where the cloud is, we would normally expect to see support coming in, and that's exactly what we are seeing. So just these piercings down in towards the cloud below that sort of 4,300 level, we're starting to see the buyers show up there. So whether that demand picture continues or whether we get a move lower to 4,000, which would still be within the clouds, will be an interesting space to watch. Switching over to the market fundamentals now, and the Bullish percent index showing us that just only 36% of the stocks in the S&P 500 are breaking upside patterns at the moment, and that's the lowest number we've seen since the pandemic lows of 2020. So this is obviously another way to state that is almost 2/3 of the S&P 500 stocks are bearish, which is an incredibly low number. It's not as low as it can go, as we've seen back here, but it could be the point at which we see some sort of bounce. Whether that's the final low or whether it's just a dead cat at this point, we'll have to wait and see. But yeah, 36 on the Bullish percent index. The stocks above their 200-day moving average across the whole of the NYSE similarly low at 35% there. The discretionary versus the staples is often a leading indicator in the market, and we can see it was a leading indicator once again. It topped out back here in November last year, started to sell off, and then we got the break lower into the new year in the index itself. So this will be one to watch. If this starts turning and making ground, then that will be a good sign for the market. Same on the semiconductors, or similar. This isn't the semiconductors price chart, but the semiconductors versus the S&P 500, so a ratio. And you can see that it's similarly just beginning to lose momentum, and the market also losing momentum. It topped out back here way back in March last year. In fact, that's February last year, and the market kept rising, but now just starting to suffer a little bit there. Semiconductors, again, another leading indicator of the market. And on the advanced decline line, we can see the effect of that sell-off there as it drops now below its moving average and starts pushing lower as the decliners far outweigh the advancers for a moment. We have seen dips below that moving average a couple of times in the recent past, most notably 2018, which we'll have a closer look at later on, and also the pandemic crash of 2020. You can see in both cases it did recover fairly quickly back to return to the bull market, so remains to be seen if that happens this time or not. I found this chart recently, which I thought was very interesting, which just shows how the sectors that dominate the market have changed through time. In the 1800s, this is the US, of course, we have real estate and finance were the big things as the expansion to the west was happening. Then the expansion of the railways through the late 1800s, and the invention of the internal combustion engine through early 1900s made transport the dominant one. Then as we got the so-called third industrial revolution with the introduction of electricity, energies and metals very much took over. But you can see lately it's been all about IT and technology companies. So interesting to see the movement of these over time. On the relative performance year to date, we can see that the S&P 500 and Russell both down around 10%, but it's the NASDAQ, those big growth stocks, those tech-heavy stocks that have really been sold off a little bit harder. They're down about 16% for the year. And one reason for that, of course, is the good old yield curve, which has been flattening, as you can see. And these shadow lines show us that it was, in fact, it's the short end of the curve that's been rising to meet the long end of the curve. And that's given this flattening type of look to it. Now, that's obviously being driven by things like inflation worries that the central banks are going to have to start raising rates to contain the inflation. And this eats into the valuation of growth stocks, which is why they've, in particular, been sold down. It also increases the cost of things like leverage and margin as well. So we're seeing a deleveraging event in the market because of this, as well as those growth stocks being sold down because they're just not looking as valuable as they were before. But don't forget, these are still historically low rates overall. This isn't this isn't a high interest rate market by any stretch of the imagination, but that flattening of the yield curve is something that will weigh heavy on the stock market, at least in the short term. We can see that another way, or visualize it another way, by looking at the spread between the 10-year and the 2-year yield. You can see that topped out way back in March last year and has been falling ever since. It's not quite at zero yet. Zero is where it would be completely flat, and then below zero is what they call an inversion, where the 2-year is actually higher than the 10-year. We're not there yet, but it's definitely heading that way. Another way to visualize it is to look at the gaps between the various maturities, 30, 10, 5 and 2, and you can see how they're all starting to bunch together, showing again that flattening of the curve. So why does that matter? Well, if it does get down to that very flat or inverted level, then that can often be indicate that we may see some recession activity up ahead. It's been pretty regular every time we've seen an inversion. We're not there yet. This one compares the 10-year to the 3 months, so the very short end of the curve, which is still a little bit steeper than the 10 and the 2. You can see it's round about the historic average that we've seen. But should this start heading down towards zero, then that's certainly something to keep an eye on, as I will in these presentations. On the sentiment, the put-call ratio, we can see the lows that were being printed really all through 2021, indicating that we were at that bullish extreme, people piling into calls because they thought the market was just going to go up forever. And you can see how the P&L pain of holding those calls has caused them to unwind, making this ratio back towards something that's a bit more neutral. So yeah, so definitely neutral, and a way where we're out of that bullish extreme and back into the mid-range at the moment. On the VIX, well, the sell-off, of course, as you would imagine, has increased volatility in the market. That's increased the demand for things like VIX futures and puts and so on to protect portfolios. That pushes the VIX higher, as we've seen, and we're now into this so-called elevated risk area between sort of the low 20s and about 40. So don't forget, though, the VIX is a mean reverting index. It doesn't trend as such. So we do see when we get these spikes up to about that 40 level, that's often a point where it stops, which could indicate a low in the market, at least a short-term one. So we may see this come back. If it blasts through 40, then things are going to get ugly very quickly. But more likely scenario is for it to pull back a little bit, mean revert if you like, and allow the market to bounce somewhere in the near future. So let's play a quick game of where to from here. I think the couple of key charts are, one is this one, which is still showing that we are historically overvalued in terms of PE ratio. So that's one. Another reason, if you like, why the market may be selling off right about now. But the other thing to bear in mind, as I alluded to a moment ago, is that we are still at historically low interest rates, despite the fact that they have been rising. So this chart looks at the ratio between the S&P 500 and the interest rates, and you can see it's very much in this neutral band. So that's perhaps a reason that we may not see, you know, a complete capitulation or a bear market or a crash as such out of this. It's more likely to be something that's a bit more corrective in nature. And if that's the case, one possible analogy is to look back at what happened in 2018, which is the yellow line here versus the blue line, which is the current S&P 500. And you can see it's a reasonably good match first. Should we follow what happened in 2018, we may get some short-term rally from where we are now, and then a final capitulation low down to about 38.40 as has been calculated here. From there, of course, 2018, the bull market continued. Whether we see that this time or not, obviously, is unknown at this point. But that's certainly one scenario on the bear side. On the bullish side, we are coming into a more bullish seasonality. February being sort of very coin toss, if you like, and coming into March, April, typically a bit more bullish before we get that May effect coming in there as well. So could be sideways if both of these play out, but yeah, they could either bullish or a bearish move into a final low into March, and then bullish out into April from there. If we look at over the long-term seasonality, we can see that it's typically February, March, very sideways, and then it does start getting more bullish up into March and April, as we saw from that last chart. Year to date, as we've seen here, it's been one-way traffic basically very low. So whether we start to see the effect of that seasonality now picking up, will be one to watch. If we look at the presidential cycle for the midterm year, so the second year of the US presidency, we can see it's very choppy looking, and dips down towards when the election is, and then sort of picks up at the back of that. The year to date is not a great match, as you can see. We're very much down. This is very much sideways. But I think this average that we're looking at doesn't give the full picture, because if we look at this next chart, this is the election cycle looking at all years, which is the black line, the midterm years, which is the blue line, which is that last chart. But then if we look at first term years, Democratic president midterm years, and second year of a new Democratic president, all of these three which are in play right now, we can see the picture is far more, at least bearish into that March period, then a little bit more bullish into March, April, and it's just a little bit more choppy than the blue line seems a little bit more optimistic compared to what we might actually see. So, but very much sideways for the first 6 months of the year anyway, we could say. On the 10-year cycle, where we're here right in year 2, and we're seeing a sell-off, so far so good. Obviously a bit too early to say whether that's just luck or whether that's actually following the cycle. We'll have to see what happens a little bit further on in the year. On Calvert's decade pressure cycle chart, we can see the rate of change starting to revert back towards zero. So that would indicate a more neutral market, or more sideways market, or price action actually consolidating in this area. So perhaps we see something of that moving in towards the middle of the year. Switching now to the Australian stock market, and on the monthly chart we can see we pushed through that 7,200 level but couldn't quite hold it. It's now sold off back, just found support back at the old 2007 high of 68.50, and it's just kind of trapped between that 7,200 and 68.50 mark at the moment. On the weekly chart, you can see this strong trend up that we had out of the bottom of the Corona crash has now been broken well and truly. So market moves sideways, just sort of pinged through that, and there again you can see that that bounce down to 68.50 and just being trapped between support and resistance right now. On the Ichimoku chart, once again, we're seeing demand show up right in the middle of the cloud, which is not unexpected. So that's a positive sign for now. Obviously, we would want the XJO to reclaim that 7200 level if possible, and soon if it can, which would be a bullish sign. On the 200 versus the other index, or other comparable indexes, I guess, the S&P 500, the Hang Seng and the Shanghai all languishing down around that 10 to 12% down for the year, which is making our market look a little bit more respectable at only about 5 or 6% down for the year. Obviously helped by the booming commodities and so on. So that's one reason why that is happening. Also, the XJO doesn't have a lot of exposure to the tech stocks or the growth stocks, so that's why it hasn't really been pummeled as much as some of these other indexes. On the currencies, well, the US dollar did bounce. If you recall, last time we were around about here and we were just looking to see whether if this was definitely a point of support, and we can say now that it definitely is. It's now back well and truly in this 90 to 104 range, and certainly making headway. Not unusual to find the US dollar booming in times of geopolitical stress. So that flight to safety helping the US dollar right at the moment. On the Aussie dollar, it's obviously not doing quite as well because of that. It's crossed with it, so it's got a little bit of a headwind from the US dollar. Probably doing slightly better than it otherwise would be, given the amount of commodity input to it, which is booming at the moment. So very much neutral and still trapped between that 70 cents and 80 cents mark. On the euro, we had that cross of this long-term downtrend, or descending triangle, if you like. Made it up to about 123, and then it's just sort of dribbled down and finding support on the upper side of that downtrend line, which can be often a bullish sign. So we would want to see that heading back towards that 123 to be confident that that the euro has some legs to the upside from here. And the Japanese yen also just suffering a little bit from the bullish US dollar. Broke out of this little symmetrical triangle and just hasn't really gone anywhere, just sort of dribbling back down once again, heading towards that 0.008 mark there. And Bitcoin, very much sideways, I think, is the story of Bitcoin. It hasn't really done anything since the start of last year, really. It's just gone up and down and up and down again. So from a technical perspective, you could argue that there is some sort of symmetrical triangle in here that it broke out of and is now finding support above. So that could be one reason. I think the thing to bear in mind about Bitcoin, a lot of people sort of see it as digital gold, but it's actually far closer correlated with the S&P 500. In other words, it's much more of a risk asset than a store of wealth. So that's something to bear in mind, that obviously the stock market's been beaten down. If Bitcoin is correlated with it, then that's unlikely to turn higher until we see some positive movement in the stock market as well. And rounding off on the commodities, crude oil, of course, with one of the biggest energy producers in the world now in the middle of a hot war, then there's no surprise that crude oil is on the rise, and you can see it gone through that old 112 level, which we haven't seen since 2013, so almost 10 years old, that line of resistance. Hasn't quite managed to hold it, not yet anyway. This is a monthly chart, but I think that's significant that we're seeing that push up that high. Gold also in the middle of war, obviously that flight to risk you start to see, and that's pushed gold back above that 1925 level. So just that consolidation below that level, and once again trying for a breakout of that level. Copper once again, or copper included in that bullish commodities outlook. Everything's really just booming across the board at the moment, apart from iron ore, who's not doing quite as well at the moment. Obviously there's a demand picture that colors this as well, and you can see that it's made it back above that 126 level, but hasn't quite got back above 175 just yet. around just sitting about the 155 level, and that's probably one reason why the Aussie dollar is not making more headway than it otherwise should have. But I'll leave you with this chart here, which is wheat. And, you know, everybody's got to eat, and wheat is a big staple in many, many parts of the world. And the last time wheat was this high, we had the global financial crisis, and the time after that it was this high was the Arab Spring. So this is definitely one to watch, because this could be indicative of, you know, social unrest or some wider contagion than we're currently seeing in the Caucasus at the moment. So keep your eye on wheat. So just to summarize that, US stock market obviously correcting off those big highs at 4,800, 4,000 is obviously the level to watch. The 200 just trapped above that 6,850, 7,200 level, just above those old all-time highs, 2007 all-time highs that is. And on the currencies, the bullish US dollar is causing the other currencies some headwinds and a little bit weakness. But the big story, I guess, is the commodities, which are all booming because of the big geopolitical risks that we're seeing across the planet right at the minute. Thank you very much for watching. It's always a pleasure to deliver these things. I hope you find some use and value from them. I wish you good luck, good trading, and bye for now.